Good afternoon, everyone. Welcome back, all the students, alumni, faculty members, and some of the media who have kindly joined this session. We have a slightly different format for today's Faculty Insight series. It is going to be a panel on the financial and economic policy response to the COVID-19 outbreak in the United States. As we saw on Tuesday in the presentation by Professor Rob Engel, the market reactions to the COVID outbreak and the social distancing stringency measures that have been taken on since then have been quite unprecedented, both in terms of the correlations as well as the volatility of the market moves. At the same time, this is not just a financial amplifier. There is a large shock to the underlying real economy itself, to some large firms, especially to the small firms, and in fact, at the level of individuals themselves, many of whom are out of jobs, on unemployment insurance, and many small businesses are working their way to stay afloat through this episode. So, unsurprisingly, the policy response has also been quite unprecedented. And today we have three experts with us. Professor Larry White from the Stern Economics Department, Professor Kim Schoenholtz, also from the Stern Economics Department. He also heads the Global Economy and Business Center at Stern, and Professor Dick Berner, who co-heads the Volatility and Risk Institute at the Stern Finance Department with Rob Engel. So without much ado, let me hand it over to the three panelists. The order in which the three musketeers will present the show is Larry first, then Kim, and finally Dick said he's going to do a little bit of cleanup of whatever damage the first two have done to the panel. So let me hand it over to you, Larry.
All right. Thank you, Viral. So first, I'm very pleased to be able to be part of this seminar series, and really thanks to Viral and Batya Wiesenfeld for setting all of this up and making it happen. I'm the opener here. The stars are going to be Dick and Kim. They're going to show you the data. They're going to show you more details on policies, but I want to try to set the conceptual stage. Now, like any good business school professor, I have to tell you what I'm going to say, then I'm going to say it and tell you what I said. And here's the overview. Basically, someone has to bear the losses. I'll get into more detail on that, then talk a bit about mitigation, talk about the mechanisms for allocating the loss. And it's important to understand the position of lenders and people like lenders, like landlords, when a borrower can't repay. And an important part of that message is bankruptcy need not mean liquidation. Yeah. So the losses, and we've seen a number of metaphors. I think the best metaphor is we're experiencing the equivalent of a sustained national hurricane, not a couple of days, not in a specific geographic area. And it's targeting people, not the physical structures plus people. And no question, there are widespread personal tragedies, premature deaths, new and exacerbated illnesses, and large economic losses, the reduced outputs of goods and services. Remember, we are primarily a services economy, and that also has the other side, which is reduced incomes. And of course, in this kind of reduction, there are going to be the direct effects, then there are going to be multiplier effects, which we all learned in our macroeconomics courses, and the dislocation effects, as there's going to be some expansion, but in different places, employing different people from where the reductions happen. How deep, how long, what recovery path? And the other area of economic loss is the diverted resources to the emergency medical and related services and goods. And that's going to show up in GDP, but it's the equivalent of the repairs after a hurricane. Yes, those repairs show up as part of GDP, but they're really just repairing the losses. All right, the one primary point, the people are going to have to bear the losses. Companies, governments aren't the real bearers because they are ultimately relationships among people. Governments are elected by and funded by constituents. That means us. So at the end of the day, someone must bear the losses, and they're going to be substantial losses. Then we get to the question of who, and one can start asking, are there culpable parties? No, I don't think so, not really. Should we just let the chips fall where they may? And should higher income individuals, higher income households be among the main bearers of the loss? All right, when we think about mitigating the losses, of course, what we're experiencing are the lockdowns, quarantines, et cetera. And on an overall basis, there's this interesting working paper by Anna Sherbina at Brandeis. She was on the President's Council of Economic Advisors a year ago, and they did a practice exercise a year ago looking at this. You can see what the benefits of the kind of lockdown quarantine are. Of course, to think about the benefits, you've got to put a value on saved life and avoided illnesses. We could spend the rest of the afternoon just talking about those particular types of calculations. But I think Sherbina has done a reasonable job there. The costs, reduced output and incomes. She may have done a little bit of double counting, but again, I think basically sensible. And there's also more intangible costs like reduced mobility, like reduced freedom, if you like. How many of us would have liked to have been at families' homes this past Wednesday night for a first night of Passover? Or at friends and families' homes this coming Sunday for Easter, and it's not going to happen. These kinds of calculations, of course, are sensitive to modeling assumptions, and we always need more data. In addition to the overall benefit cost test, there's a marginal benefit cost set of issues that are also relevant. You want to know first on the intensive margin, how severe should the suppression measures be? And then there's the extensive margins. There's at least two, which sectors and for how long. And again, we need more testing. And, I show you links to the Sherbina paper. You may also want to take a look at the economics of lockdowns. Trigger warning. This was a webinar that was hosted by the Cato Foundation yesterday. There are some things in there that many of us don't agree with, but I think there's an awful lot of good, clear, sensible thinking that gets enunciated in that webinar. All right, so as we think about mitigating the losses, it's important to remember that economic relationships are likely to be important in the economy right now and quite important for the recovery. And there are those kinds of economic relationships. You might say, well, maybe the eroding of some of these relationships can lead to more innovative arrangements in the future. Maybe. But we need to remember about relationships. All right, so suppose an enterprise experiences a downturn in business, and the customer, I'll give you examples, and customers don't want to patronize, the employees can't or don't want to show up, supplies may be hard to procure, and of course, suppose this is widespread. First, let's suppose the owners, the employers, bear the loss. They continue to pay out to their employees, their suppliers, the creditors, the landlords. Well, they're going to have to draw on liquid assets, or they're going to have to borrow. And then who's going to lend to them, on what terms? And it's important to remember, borrowing doesn't cure the loss, it just pushes the borrower's loss bearing into the future. Now, this kind of scenario does maintain the relationships, but how long can this continue? Now, you can say, enterprise owners tend to be higher income, so asking them to bear more of the burden, okay, I get that. But you also have to think, well, pension funds, when it comes to corporations, are major owners, and their beneficiaries are the owners. What about them? They probably, on average, the beneficiaries, if they are part of a pension fund, probably above average income as well. All right. Next, suppose instead the employers say, no, I can't bear the loss. I'm going to close down. I'm going to severely retrench. And then it's the employers, the suppliers, the creditors who bear the loss. And then, of course, we're into wider macroeconomic consequences with multiplier effects, dislocation effects. Of course, there's going to be some buffering from in-place stabilizers, unemployment benefits, supplemental nutrition assistance program, what we used to call food stamps, women's, infants, children, nutrition. But there's going to be relationships eroding, and then there's this real question, what about those contractual obligations with their landlords, with their creditors, suppliers? And the same issues arise when an individual's obligations are in question. Now, in fact, what we're seeing is the federal government as the social insurer that spreads the loss more widely. The Fed, and you're going to hear much more about this aspect from Dick and from Kim. But you have to start asking, are other programs going to be cut? Is the tax system itself that's going to be used eventually, sooner or later, to repay? Is it progressive? How much support to whom? And if it's enterprises, so as to preserve those relationships, should government be acquiring equity positions in corporations? How quickly, how effectively, how thoroughly, who's going to fall through the cracks? And then should that support be in the form of grants or loans? And again, remember, loans provide liquidity, but they just push the borrower's loss into the future. What can borrowers do when what can a lender do when a borrower says, I can't pay? Well, there's going to be some loss that the lender will highly likely have to bear. The lender should be looking for the least cost outcome. The lender can restructure the loan, and we saw a lot of that in 2008, but the lender has to worry about moral hazard, or the lender can foreclose, repossess, or for commercial and force a bankruptcy, but there are going to be added transactions costs, and there may be some neglect of social spillovers. And it's just important to remember, when loans are securitized, we've got extra complications because there are multiple lenders and an extra layer that creates an additional agent principal problem. The last important point I want to make, bankruptcy for large companies need not mean liquidation. They can continue to function. Yes, the owners' shareholders get washed away. The lenders take haircuts, become the equity stakeholders. Incumbent management may be kept or new management installed. And all of the major airlines have gone through bankruptcies at least once and have continued to operate. Or there can be liquidation. If bankruptcy but continued operation was the alternative, then you got to understand government aid to such a company is primarily a bailout of owners and lenders. And so there are my conclusions. I've gone a bit longer than I had hoped I would, but I hope I've set the stage. Dick, Kim, it's over to you.
Thank you, Larry. So good afternoon, everyone. Thank you, Viral, for organizing this panel. It's really an honor to be here with Professors Berner and White. So my role today is really to discuss the Federal Reserve's response to COVID-19. Suffice it to say, the Fed's actions are breathtaking in scale, scope, and speed. In less than 6 weeks, the U.S. Central Bank already has gone far beyond its extraordinary actions in the crisis of 2007-09. The Fed appears committed to do whatever it takes within the law to counter the impact of the COVID crisis on the economy and the financial system. Put differently, the Federal Reserve is now on wartime footing and is prepared to use its emergency tools to support the government's battle against the coronavirus. I believe an apt analogy is to the Fed's role in World War II, when it set monetary policy to ensure the smooth financing of the war. Given the circumstances, it is very good news that the Fed is finding ways to support the government's efforts. There is much that it has done and can still do as lender of last resort, market maker of last resort, and as monetary policy maker. At the same time, I am concerned that the Fed's new role as a key allocator of credit to non-financial entities, a role as a state bank, is one that will be difficult to shed when the challenges currently facing private markets fade. Why is this important? Over the past 35 years, Federal Reserve monetary policy independence has been vital to securing U.S. price and economic stability. Going forward, however, the deep engagement of the Fed in politically sensitive distribution issues, like the allocation of credit to non-financial firms and municipalities, raises doubt about the sustainability of independence. Put simply, independent banks do not make fiscal policy. That is for elected officials. With this in mind, let me highlight the Fed's aggressiveness. Compared to the crisis of 2007-09, when it took 16 months to lower interest rates close to zero, the Fed did so last month in 2 weeks. It also announced unlimited quantitative easing, QE infinity, something that was introduced only years after the financial crisis was over. And it revived an alphabet soup of so-called expired policy tools from the crisis, including dollar liquidity swaps with foreign central banks and various lending facilities to non-banks, like the primary dealer credit facility and the money market lending facility. These actions already have swelled its balance sheet to a record $6 trillion. That's the April 11th black dot in your chart. The increase is driven by massive gains in lending to financial institutions and in treasury holdings. Going forward, the announcement of new programs for allocating credit to non-financials portends a further large increase in the balance sheet. Indeed, rather than using the government's own balance sheet for such fiscal purposes, the CARES Act calls on the Fed to do so, and it provides a taxpayer backstop. It's worth contrasting this new state bank role with the Fed's historical approach. Traditionally, the U.S. Central Bank aimed at asset neutrality, setting the interest rate on safe assets while allowing private firms and markets to allocate risky credit. While the Fed can accept the liabilities of non-financial entities as collateral, even in the crisis of 2007-09, its direct role in credit supply to these non-financial entities was limited. For example, the Fed's commercial paper funding facility supported a market which at that time accounted only about 20% of the issuance was from non-financial firms. Following recent Fed announcements, including those from yesterday, asset neutrality is no longer a key objective. A new alphabet soup of facilities will provide about $2 trillion in credit against collateral, including loans and bonds to corporations, and small businesses as well as municipalities. And the Fed already is extending the riskiness of the acceptable collateral to sub-investment grade instruments, presumably backstopped by taxpayers through the CARES Act or through the Treasury's Exchange Stabilization Fund. To be clear, the Fed ought to be on wartime footing. It should ensure that the financial system is able to perform its critical functions of facilitating payments and delivering credit to healthy borrowers. Moreover, as in World War II, it should be prepared, if necessary, to limit the cost of financing the government's battle against COVID-19. At the moment, however, Treasury funding costs are at or close to record lows. So the question is why the CARES Act uses the Fed's balance sheet to allocate credit to the non-financial sector. As an alternative, Congress could have given Treasury the authority and the budget resources to implement all these mechanisms for delivering credit to non-financial entities. Under that approach, the credit provided would appear transparently on the government's balance sheet. Instead, under the current arrangements, it could take many years for the Fed to put its new politically sensitive emergency tools away, even after they are no longer needed. Indeed, it took 6 years for the Fed to gain a modicum of independence after World War II, even when the Fed was primarily financing just the federal government. Let me close with a few words on whether the Fed's actions will work. Based on recent labor market developments and on private forecasts, the current recession will be the deepest U.S. economic downturn since the Great Depression. With long-term interest rates already so low, the impact of forward guidance and quantitative easing is likely to be more limited than it was in the crisis of 2007-09 or in the subsequent recovery. Consequently, discretionary fiscal policy, which Professor Berner will now discuss, is front and center in this crisis. Ultimately, however, the impact of both monetary and fiscal policy depends on the effectiveness of our public health efforts. Economic policy can help us while the economy is in suspended animation. But the longer that period extends, the greater the wave of bankruptcies that could swamp the financial system and impede recovery. So while the Fed is doing its part to fight this war, the real battle for the nation's well-being, including its financial and economic well-being, remains with our healthcare workers. To them, we will be forever indebted.
Okay. So thank you, Viral and Batya, for setting this up. And like Kim and Larry, I am honored to join my esteemed colleagues on this panel. So like Larry, as a good business school professor, I'm going to give you the punchline right up front. In terms of fiscal policy, we've gotten fiscal relief. We've gotten a down payment to support the economy and preserve essential services. But it is merely that, and more is definitely needed and on the way.
Dick, I'm sorry to interrupt. There's some disturbance coming in. I don't know if it's your cell phone that's interacting with the microphone or something, but there's some static that's coming in. If you're able to just push it aside, it might help. Thank you. Okay. Sorry, everyone.
All right. Let me know if that persists. So one of the things that Viral alluded to at the start was the work that we are doing to show the tracking of cases and volatility in financial markets. And you can see that on our website, which I depict here. This is from yesterday. And you can see how that's spread and which markets are being affected. And that's important when we think about this on a global perspective or in a regional perspective when it comes to fiscal policy, which coordinates between the federal government and state and local governments. Now, Larry set the stage in terms of talking about what we have in front of us. First and foremost, obviously, we have a dramatic healthcare crisis that involves shutting much of the economy down, not just here in the US, but also globally. And that creates both supply and demand shocks. And it's important to take a moment to look at those because they drive the policy responses that we're getting. The supply shocks, I think you're pretty familiar with the spillovers, the loss of employment, the spillovers through global supply chains, and not incidentally, the provision of essential services, which can be threatened. On the demand side, I think it's important to think about the lost income, the focus on necessities, whether or not there's access to credit, as Larry and Kim both indicated. But I think it's also important to talk about the uncertainty and risk aversion in this crisis, because while currently it appears that we may be approaching a turning point, that's highly uncertain. And so people are, that risk aversion gets amplified. And it gets amplified on a global basis because we have a highly connected, interconnected global economy. In addition, the shock from COVID, I think, exposed a number of vulnerabilities and amplifiers. Economic vulnerabilities, a frail economic safety net, a global slowdown, an oil price war that dragged down production, the impact of an ongoing trade war, and whether or not our emergency responses were coordinated or not. And the financial amplifiers that Viral alluded to, but in particular, I want to talk about the fact that corporate America, non-financial corporate America, had embraced high corporate leverage, and we saw weak credit quality. And the other kinds of financial amplifiers are there. Just to illustrate on the safety net, when we look at our state unemployment insurance trust funds, they are clearly, depending on which state you look at, even on the eve of this crisis, they clearly were not adequately funded, and the infrastructure for distributing unemployment insurance benefits was also fraught, and still is. And in terms of corporate leverage and defaults, we have seen a dramatic increase in corporate leverage, measured here by non-financial corporate debt, relative to corporate non-financial corporate GDP in the black line. And you see two default rates here. One is for commercial and industrial loans, which so far has been benign. But second is the default rate for high yield debt from our colleague Ed Altman. And that has already shown signs of deterioration. You look back in history and you see the kinds of defaults and bankruptcies that we had in past recessions, particularly the most recent one. So I think that frames for us the policy goals. And as Kim and Larry have both indicated, we're trying to balance fighting the virus and limiting the economic damage with an assessment, to the extent we have data, of the benefits and costs of doing each. So it's essential that we have policies that build confidence in health outcomes and preserve essential services. And on that latter point, it's important that we get critical aid to state and local governments to do that, and equipment, and maybe use wartime powers, not just at the Federal Reserve, but elsewhere as appropriate. And we need to help people stay at home. And Larry talked a lot about that, by funding sick leave, replacing lost income, and deferring obligations to pay bills, including rent and loan obligations, and providing loans and grants to support people and businesses, to help the Fed to support market functioning, as Kim discussed, and as Larry also indicated, to preserve our economic infrastructure and relationships for recovery. So what have we gotten? We've gotten three phases of fiscal relief. First, in very modest terms, to help state and local governments. Second, tax credits for employers, often paid sick leave. And then third, which you've probably read a lot about, a $2 trillion tranche in phase three, which was enacted at the end of last month, that provided a lot of relief in broad terms. As with the Fed's response, this has been breathtaking, it's been bold, it's been relatively speedy, given the political process, and it's been widespread. And the numbers here that you see in terms of the distribution of outlays look large. $500 billion to help big corporations, $377 to help small businesses, and so on. Relative to a $21 trillion US economy, however, these numbers are not all that large. It sounds big, it sounds 10% of GDP, but when we think about the aid that is going to individuals, it is really only sufficient to maintain them for a relatively short period of time. So when we ask whether these actions meet these goals, I think it's important to recognize that this is not fiscal stimulus in the usual sense. It's really a down payment for health providers, for state and local governments, and for income support. And the need has been amplified by the deficiency in the safety net that I talked about a little bit. Further, when we think about reaching people who are low income, that is challenging because either they don't file tax returns or they don't get Social Security benefits. And last, the official resource infrastructure that we have is being overwhelmed, and that slows down the speed of the payments. The good news is that there's likely more relief on the way. There's been talk of an extra $250 billion for small business loans that got held up in Congress just yesterday, and additional aid for hospitals and for state and local governments. And then to preserve our prospects for recovery, there's going to be more stimulus that's needed. I want to mention at this point that there's also an international development here. When we think about the spread of the coronavirus and its impact on the global economy, it's particularly acute for emerging market economies. We've seen $100 billion in outflows from those economies, depriving them of resources needed to support their populations. Now, the IMF is standing by to help, and lenders are also proposing a standstill, along with official support for that, a standstill in loan payments by emerging market economies. And I think that fits the script that Larry was talking about in terms of who has to pay. And in that case, the lender and the borrower share in the pain. So a couple of comments that reflect what Kim was talking about with coordination of monetary and fiscal policy. Kim talked about the Fed programs that are being backstopped by the Treasury. We've seen a number of those, both in the CARES Act and even before that, to back some of the Fed facilities. And if there are more facilities, it's clear that they're going to require more Treasury backstop. In the Fed minutes, we saw a mention of the term auction facility, which will provide term liquidity. And there are questions about facilities for mortgage servicers, a point Larry raised, for our government-sponsored enterprises in housing, namely Fannie and Freddie, for insurance companies who may need liquidity in order to make good on payments. And it may be necessary to expand the range of financial counterparties in existing or new facilities. All these will involve coordination between the Fed and the Treasury, either in terms of backstop or direct assistance. And I think it's important also to note that indirect coordination is occurring because the Fed and other regulators have been encouraging banks to draw down their capital and liquidity buffers. And if the banks are not as resilient as we think, then some recapitalization of the banks may be required. It would be great if they could do that on their own, but it may be that they're going to need some assistance in certain cases. Other regulatory relief, I think, has also been helpful. And the question is whether or not that leaves the banks resilient enough to survive what we're going through. And then when we get to recovery, there'll be questions about coordinating what the Fed does with debt management policies. My suspicion is that won't be like what we saw in the global financial crisis. There's probably going to be more coordination. So I share Kim's concern and a couple of ways that we might think about alleviating that concern. Congress authorized the Treasury to backstop the Fed. Congress could equally authorize the Treasury to take back some of those facilities onto the national balance sheet and make them Treasury rather than Fed facilities, which would alleviate some of those concerns, and that might be helpful. So I will stop there.
Great. Thank you so much, Larry, Kim, and Dick, for providing this both summary, conceptual framework, as well as some sort of a guide path as to where we are likely to end up as the economic fallout worsens and more economic data comes in over the next few months and quarters. Let me take some questions from the audience. I had a question in my mind, but it's very close, Larry, to a question that Jason Smith from the NYU EMBA program has asked. And the question is, doesn't bailing out zombie companies like airlines empower CEOs and boards who have sort of not run their balance sheets too well? The precise term he has the precise adjective he has used is crappy. Shouldn't they go through the bankruptcy process? It's not like bankruptcy will lead to companies being shut down in the short term. Sophisticated investors know the risks they take when they make an investment. And I think the final question is really a very deep one. Is capitalism dead? Over to you, Larry.
Yes. All right. Crappy, a technical term in finance. Isn't that right, Viral? Look, there are serious issues. Should the airlines have maintained more liquid assets on their balance sheets so as to be able to at least handle part of the losses that they are experiencing? But, this is so massive that I don't think it was reasonable to expect them to have had so many liquid assets that they could survive without anything else. So then the question is, should they go through a bankruptcy? And if they have a viable future, presumably the lenders, maybe the lenders with some encouragement from the federal government, would be able to figure out a way forward. Again, bankruptcy typically washes away the existing creditors, and the lenders take a haircut, become the owners. They decide about what management team they want. How you think about whether there should be a bankruptcy or not, you got to remember, if there is a bankruptcy and the alternative was that they would have remained in operation, like the airlines have done over the last 20, 30 years, then what the bailout does is, what the support does is bail out the existing shareholders, the existing creditors. You got to decide what you think the right outcome is. I just think it's important to recognize that bankruptcy does not mean liquidation, at least for a publicly traded company.
Just follow up on that, Larry, with a related question that has come up from Omara Ali from the Langon program. And this refers to, in addition to bankruptcy, whether you see M&A activity as being a potential way that the industry might sort itself out, as firms which have cash constraints and likely unable to weather the storm are perhaps sort of acquired or merged into firms that have run extremely prudent balance sheets or are sitting on large stockpiles of cash. How do you see this playing out during and post-COVID as a potential alternative to bankruptcy for some of these firms?
No question. There will be some acquisitions. As many of you know, I come from an antitrust background, and so I sure hope that the Antitrust Division of the U.S. Department of Justice and the Federal Trade Commission will be, they will have the legal powers to review such acquisitions and they ought to be maintaining strong competitive frameworks for deciding, is this a sensible acquisition or no. But of course, if the alternative is that the business fails and doesn't, can't go on, then, that business is going to disappear anyway. And so maybe an acquisition is the best outcome. There's no question there are going to be lots of M&As, or certainly proposed M&As on the landscape in the near future. No question.
That's great. Thank you, Larry. Let me turn to Kim now. There's a question that was on my mind. I think it's on minds of a lot of investors. Rob Engel has proposed it in the Q&A as well, and so has Brett, which is typically the kinds of public debt growth and central bank balance sheet growth that we are already witnessing. And as Dick Berner pointed out, we are likely to see more of this. Historically, these have been followed by episodes of either severe repression, in which you have to channel savings of the economy through restrictive policies into public debt, or they have been sort of dealt with through monetization by the central bank, or what economists have called as fiscal dominance, where the central bank has to start worrying about the public debt getting rolled over without problems rather than worry about inflation and other mandates. So the question is, what do you think is the likely path over the next decade or two on treasury rates, inflation, taxes, as once we are out of this scenario in which almost surely both the central bank balance sheet size as well as the public debt to GDP programs in all developed economies are going to be at unprecedented high levels other than sort of wartime scenario. Kim, do you want to take this on? And Dick, please feel free to chime in once Kim has responded.
I hope that Dick has a crystal ball that goes out 2 decades. Mine doesn't quite go that far, but I'll do my best. Look, I think it's a great question, and it is true that we have seen in the past when there are massive increases in debt, for example, for wartime finance, that wartime finance typically leads ex post to periods of either higher inflation or to repression. That happened after World War II, as a good example. However, I think we have to be careful in the current episode and think back to a period more like the Great Depression. We don't yet know the extent to which this shock, or the shocks that we're experiencing, are going to be dominated by supply or demand shocks. And the longer that the isolation process goes on, the social distancing goes on, the likelihood is that we will see a larger and larger wave of bankruptcies that will have an impact on demand and on the structure of the economy going forward. So, frankly, I'm not surprised that Jay Powell said yesterday that inflation is not the critical issue that they're focused on at the Fed at this time. They're trying to make sure that the economy doesn't fall into such disrepair that it's not reparable. And so, and I would also say that if you look at markets around the world, long-term bond markets, they're not flashing red signs about inflation. Quite the opposite. They seem to be warning us that the risks of a deflation are greater. So I don't want to sound complacent. I think it's a good question to ask, and we should remain alert to the risks, especially, for example, if central banks are stuck in the role of playing fiscal policymakers for a long time to come. In that world, they could do damage to economic growth, and ultimately someone will have to bear those losses, either in higher taxes or in inflation as a substitute tax. So we should be alert. I don't think that's the key issue at the moment.
Let me just add to that, if I could.
Yes, please, Dick. Yeah.
Large, I agree with Kim. I think the near-term risk. And by that, my crystal ball is no less cloudy than his. So, I think the near-term risk for the next few years is probably lower inflation and maybe even deflation for a short period of time. So I'm not worried about that. And so I share Jay Powell's concern. And I think the analogy to the Depression is more apt than it is after the Second World War. But it's mixed because there is going to be a great shift in resources. And we don't know exactly how that's going to play out. There will be massive changes in business models, particularly in the service parts of our economy that we're all aware of that are being hammered right now. We don't know the extent to which technology will help us with some of these things because we haven't seen the innovation that may occur that will keep inflation down. And we don't know the extent to which this shock and its consequences will ripple through to affect investment and productivity and the infrastructure of our economy. Now, Larry talked about maintaining those relationships. It's pretty clear to most of us that some of those relationships need to change. And in fact, there may be a tiny silver lining in this crisis that some of them will change in a way that is positive. We're not quite sure, but we need to be wary and vigilant about exactly how those things are going to play out and whether or not over time they will promote inflation. As far as the fiscal issues and the debt issues are concerned, I'm a card-carrying member of the school that says when you start approaching debt that's 200% of GDP or whatever we're headed for, you should watch out. And we need to have a fiscal policy that is sustainable. However, I'm also mindful of the lessons from Japan, where they do have 200% of GDP debt. And many people have tried to talk about inflation in Japan and to short the Japanese government bond market, and neither of those two things have materialized. So we're in uncharted waters. And frankly, our crystal balls don't really give us a lot of guidance right now. We need to watch those supply and demand shocks that Kim and I talked about.
Great. Thank you, Kim and Dick. Just as an aside, having grown up in an emerging market and having spent some time at a central bank there, my experience has been that there's sort of two trajectories at high public debt to GDP levels. One is sort of outright monetization by the central bank, where the dominance leads to some loss of inflation credibility, and then any shock could lead to an inflation spiral. The alternative is one of sort of very high levels of repression for long periods of time, in which case you get sort of low growth, low inflation sort of environment. And so I just wanted to put that on the table that lack of inflationary signals in the market may not necessarily be good news, because that might reflect in part the expectation that we are likely to be in a crowding out repressive zone for a long period of time. Not so bad for bondholders, but not that great for growth in the economy. Let me turn now to...
Viral, yes, can I just jump in for a second?
Oh, absolutely,
because,
absolutely.
As
yes.
Kim and Dick know, I am wary of that parallel with Japan, because the US dollar has been a reserve currency for the last 70 plus years. The Japanese yen is not. And so it may be a lot easier for the Japanese economy and government to have a 200% debt to GDP ratio than it would be for the US if it wants to continue its role as a reserve currency with the benefits, soft power, and monetization, et cetera, that goes along with that.
And Larry, I couldn't agree with you more. If anything, this crisis underscores the fact that there is no alternative to the dollar. And what Kim has described is essentially not just the Fed being lender and market maker of last resort and state bank, but has become the global central bank, the lender to the world as a whole. And so we all come down to confidence in the Federal Reserve when it's appropriate to shift from what it's doing now to its traditional goals of making sure that we have price stability.
If I might jump in on that, Viral, there was a question I thought earlier about whether, the Fed's actions are taking account of what's happening outside the United States. And I think they definitely are very much aware of it. They're very much aware of spillover and spill back into the U.S. And one of the best examples of that is the central bank liquidity swaps that were introduced aggressively last month and have already gone a long way to diminishing some disruptions in short-term financing markets. So remember, it's worth keeping in mind what I call the global dollar system. The system of dollar-based financing outside the United States is actually larger than the commercial banking system inside the United States. So the need for dollar funding is enormous. And the Central Bank of the United States has stepped into that role again, as it did in the crisis of 07-09, to be the lender of last resort in that market. So the other question that came up, I thought, related to that is, what about coordination with other central banks? So in this area, they obviously are coordinated, but it's worth keeping in mind, if the Fed's ammunition is limited, meaning long-term bond yields here are already quite low, and there's a limited effect they can have, the limits that face central banks in much of Europe and Japan are even greater. They already start with zero or negative long-term interest rates. So the ability that they have to influence their economies is even less than the Fed's. And so the reliance on fiscal policy there will be even greater than it is in the United States.
And if I could conclude this dialogue with two brief points. One is that the Fed is not the only central bank that is setting itself up as the state bank. Other central banks are doing similar kinds of things, notably the Bank of England in its own lending operations. And the second point is that to the coordination point, it would give markets, and I think in investors and business people and consumers, a lot of confidence if we saw, in response to this global pandemic, global coordination, not just of monetary policies, but also of other policies that were aimed to solve the health crisis in a coordinated way.
Great. Thank you, everyone. Just in interest of time, let's squeeze in 2 or 3 quick questions with sort of very brief responses. I'll try and channel them to one of you. Larry, the first question is for you. You discussed about the virtues of bankruptcy in the sense that it doesn't necessarily mean liquidation. Would you carry over that concept also for micro, small, and medium-sized enterprises? If yes, why so? And if not, what do you recommend be done for the MSMEs?
Sure. With smaller enterprises, the real issue is, do you have enough confidence in the current management that you're willing to restructure the loan, or are you in your position as lender, or do you say, I just don't think this enterprise has a future, and I'm better off foreclosing, liquidating, getting what I can, rather than restructuring the loan and hoping this enterprise is sometime in the future going to be able to pay me back. Those are difficult decisions. Lenders have to do them all the time. Again, back in 2008, 9, and 10, real estate lenders, mortgage lenders had to be making those kinds of decisions vis-a-vis homeowners. It's a standard issue for any lender when the borrower says, I can't pay. So, it just has to be that kind of issue. If we do have government assistance, yes, it's going to help the borrower. It's going to help the owner. That may well be what we want to do. These are tough decisions.
Next question, over to you, Kim. It seems that increasingly the Federal Reserve is playing the role of a lender of last resort, not to specific depository institutions, but to markets at large, markets for corporate bonds, markets for commercial paper, markets for municipal debt, etc. Do you think this is a step in the right direction as the economy becomes more sort of market financed rather than bank financed? Or do you see substantial moral hazards in sort of casting the safety net across even to market investors?
I think we have to be careful. I think lender of last resort efforts really are focused on making sure that liquidity is available for institutions, and in particular in some money markets where those institutions might finance themselves. So past interventions in short-term financing markets fit that definition. They would have fit Bagehot's definition back in the 19th century. But when it comes to allocation of credit, I don't view that as lender of last resort. And I think that up until recently, the Fed did relatively little of that, even in the great financial crisis. They did, of course, intervene in the mortgage market. That was in some sense the biggest effort at allocating credit, but they were buying only assets that had federal government full faith and credit guarantees. So the new state bank approach involves them actually allocating resources to default risky institutions. And that's a very different pattern, I think, that we've seen generally in the past. That's what I think, as Dick suggested, would probably be better located on the Treasury's balance sheet than on the Fed's.
That's great. Thank you, Kim, for that really crystal clear response. Last question, over to you, Dick. It's a combination of questions, but I'll make it into one. How do you see all this, the COVID-19 response, play out in a couple of years down the line in terms of two outcomes? One, the relationship between US and China, notably the US government debt ownership by China, which relates a little bit to the reserve currency issue that we discussed earlier. And second, how do you think companies are likely to plan for such pandemic stress tests going forward?
Two very weighty questions. I'm not a China expert, but I would venture to say that the answer to that lies to some extent in politics. In the post-World War II period, we have built up alliances around the world and in the United States, and we've shown global leadership in that regard. We've tried to do that in a number of ways with respect to China as well, encouraging China to join, for example, the World Trade Organization, in other arrangements in which China is a participant and has a seat at the table rather than is on the outside. That has proved to be very difficult. I think it will continue to prove to be very difficult. And frankly, I think that a risk in this crisis is that we will see more, not less, nationalistic policies and more assertion by China to assert a global leadership role in the world economy and in world politics. So that's going to be a real challenge, not just for economic relationships, but for strategic and political relationships as well. And it bears on a whole range of issues that we will be grappling with. The second question is, how will businesses, and for that matter, I think we should extend it to governments, and all members of our society be prepared to deal with pandemics in the future and for other kinds of risks? And I think the answer is we have to build resilience. We have to be prepared. Clearly, we did not have resilience in our healthcare systems. And comparatively, Viral, as you know well, emerging market economies have even less resilience than we do in that regard. We have to think about all the things that can go wrong and how in a globally interconnected economy, we can see shocks transmitted from one part of the economy to another. So there's going to be this huge tension between a world that is still globally interconnected, and national policies or nationalistic policies that tend to move that apart. And coordination, I've maintained is always the answer here. It's difficult to achieve, but we need to think about what our global relationships look like. How resilient are our supply chains? How prepared are we for the next pandemic? Because it does seem to me they become increasingly frequent. And how are we prepared to meet other challenges out there that are still important? Challenges from climate change, which may be related to pandemics. Challenges for geopolitical risks and cybersecurity risks. All those things are things that I don't think we're prepared for, and we need to start doing that.
Thank you very much, Larry, Kim, and Dick, for a really stimulating session. Thank you as well to all the participants from faculty, students, alumni, media for your excellent questions. As we get back to the sobering reality of our current lives, I'm glad to see that the Stern faculty who are on the panel today seem extremely resilient to stressful questions. So very well done. All the best to all of you. Stay safe and take care.
Thank you, Viral. Thank you.
Bye.
Thanks to my colleagues.
Thank you, everybody.
Yes, thank you. Thank you, everybody.
And thank you to all the admin staff for helping us run the Zoom session really seamlessly.
Agreed.
It was excellent. Thank you. Bye.